Someone standing in 2140 will look back at this time and see clearly who was building the bridge from the old system to the new one, and who was standing on the old side calling themselves a Bitcoiner. From the future, the distinction will be obvious. From inside the overlap where we are right now, it's the hardest thing in the world to see. In 2026, the cost structures and revenue models of the legacy system have made their way into nearly every layer of Bitcoin's human infrastructure. If we looked at Bitcoin like a company, we would find fiat incentives everywhere. Marketing, sales, development, funding, and even our own choices as individuals. What follows covers strategies STRC and the Cantillon dynamic it rebuilds on top of Bitcoin. The sponsorship loop that shapes what Bitcoin creators will and will not say. The concentrated funding pipelines behind Bitcoin Core. Original research showing why the companies that raise the most capital drift the furthest away from Bitcoin. And the dilemma each and every one of us faces. While rent is still denominated in fiat, I want you to know the protocol is doing fine. Bitcoin is fine. The human infrastructure around it is where fiat got in. It was inevitable. But here's why it's important for you, for me, and for Bitcoin. Strategy's capital structure represents a genuine financial innovation.
Stretch was, people said, yeah, I'd like to get 10% bank account instead of 5%, but I don't want the volatility. So we wanted to find some way to get to $100 and keep this price right around par, right around 100. Okay, and so the idea of Stretch is we don't want duration risk. So we wanted to strip the volatility off when we stripped the duration off. To do that, we had to create a monthly instrument, not quarterly. So this is the first time in modern capital markets that a company created a preferred stock that has a variable monthly dividend. And so we call that a treasury preferred. I used AI to do it. Yeah. In essence, Stretch becomes like, it's not quite a high yield bank account. So the idea is a Bitcoin backed money market type instrument, not quite as good as a money market. They're less volatile, but we wanted to compete with that, with Bitcoin backing it.
Though whether it serves the investor or the accumulator is worth looking at a little bit more closely. STRC functions as follows. The investor gives Strategy $100 per share, and Strategy uses that $100 to buy Bitcoin, which goes into their corporate balance sheet. The investor receives approximately 96 cents per month at the 11.5 annualized rate. Strategy has raised that rate 7 times since STRC's July 2025 IPO from 9% to 11.5%. A raising rate signals raising cost of capital. The investor holds no direct claim on any of the Bitcoin and no right to demand the original $100 back from Strategy. STRC has repeatedly broken below its $100 par value. As of recording this video, it's trading around $74, roughly 25% below par. But where does the monthly payment come from? Bitcoin generates zero cash flow. It pays no interest, no rent, no dividends. Over the long term, it appreciates in purchasing power, but it produces nothing. So the cash paying the yield comes from other sources. First, new investors buying STRC shares through Strategy's at the market or ATM offering program. Second, cash reserves, which stood at roughly $1 billion as of early June 2026. Third, the company's software business revenue, which is small relative to the preferred obligation. And fourth, selling Bitcoin directly. In late May 2026, Strategy sold 32 Bitcoin, its first sale since December 2022. 3 conditions must hold simultaneously for the structure to function. Bitcoin must appreciate at a minimum of roughly 2.05% per year. Sailors stated break even as of April 2026. A hurdle that rises as obligations grow. Investors must continue buying STRC at a near $100 because Strategy cannot sell new shares below par without closing the ATM program, a condition already under pressure. And no confidence crisis can run longer than the reserve runway, which stood at approximately 6 to 7 months as of early June 2026. So the structure does what it says on the surface. New capital funds existing obligations, Bitcoin accumulates on the balance sheet, and fiat-denominated yield flows back to investors. What the filings cannot tell us is whether the structure is sustainable across the full range of market conditions, or only in the conditions that favor it. What the structure adds is the circularity. One yield products reserves, are another yield product's obligations. And so there are three scenarios that can be seen as factual possibilities. First, a prolonged bear market where Bitcoin drops 50 to 75% and stays down longer than the reserve runway, during which STRC falls below $100. The ATM program closes, and reserves drain at approximately $1.7 billion per year. Second, obligation growth outpaces Bitcoin returns over time, as each new STRC issuance increases annual obligations, while Bitcoin's long-term compounding annual growth rate compresses as the asset matures. Third, a confidence crisis, which requires no catastrophic price movement, only for investors to stop buying STRC near par. Confidence-dependent structures fail suddenly and reflexively, and the speed of the failure is often what catches participants off guard. The standard defense is coverage. At current prices, Strategy's Bitcoin is worth many multiples of the $1.7 billion annual obligation, and the company could, in principle, sell a small fraction of its holdings each year indefinitely. That's true at current prices. The structural catch is that the collateral is marked in the same asset whose drawdowns define the failure scenarios. The deepest structural argument against STRC centers on what Bitcoin was designed to do and whether STRC reconstructs the exact dynamic that Bitcoin was designed to end. The Cantillon effect describes the mechanism by which those closest to the money printer extract value from everyone else before newly created money reaches the wider economy. The person who receives newly created money can first spend it at yesterday's prices. By the time that money reaches ordinary participants, prices have risen and purchasing power has fallen. This is the operating logic of the fiat system. It's baked into its architecture. Bitcoin's design addresses this from two angles: fixed supply, which means no new issuance, and decentralized proof of work, which means no privileged access point. Every participant holds the same asset under the same rules, with no insider position relative to new supply. The Cantillon mechanism requires a proximity advantage, and Bitcoin's architecture makes a proximity advantage structurally impossible. STRC rebuilds a similar distributional dynamic on top of Bitcoin, a protocol designed to make that impossible. Retail dollars enter Strategy through STRC issuance. Strategy converts those dollars into Bitcoin. Bitcoin accumulates on the corporate balance sheet. Fiat-denominated obligations flow back to investors, retail investors, who receive a monthly dividend. Strategy occupies the top of this flow, in the exact position the Cantillon insider occupies in the fiat system, accumulating the scarce appreciating asset while redistributing the fiat obligations to retail investors, to the participants furthest away from the accumulation of wealth. Of course, this analogy is imperfect. No money is printed, no outsider is diluted, and every STRC buyer participates voluntarily and is paid for it. What is reconstructed is the geometry. The entry at the accumulation point holds the scarce appreciating asset, while the participants furthest from it hold claims denominated in the depreciating one. The fiat system needed a money printer to create that dynamic. STRC produces something similar on top of Bitcoin by providing yield. If Strategy reaches 1 million Bitcoin, as Saylor has stated as an aspiration, that represents nearly 5% of all the Bitcoin that will ever exist, concentrated into one single corporate entity. The question the Cantillon reconstruction surfaces is whether a tool can simultaneously end an extraction logic and serve at the same time as fertile ground for a new version of that very same logic. Saylor's conviction about Bitcoin is genuine, and it's been documented across years of public statements and phases of accumulation. The current phase, 5 preferred classes, AI-generated advertising comparing STRC to a bank account, clearly exist in a different relationship to that thesis.
Which one's the best crypto asset? Well, Bitcoin's the best crypto asset. Okay, what's the second best? There is no second best. There's no second best crypto asset. There's a crypto asset. It's called Bitcoin, right? Right? There's no second best. Okay. It's not like Google and Facebook. It's not like Apple and Amazon. Yeah, we can debate Apple or Amazon. What's better? They both look like tech monopolies to me. They both look pretty good. On the other end, Bitcoin or no, Bitcoin. Bitcoin's crypto asset. This entire idea of like 60% dominance is bullshit, ridiculous, stupid, right? Like, it's stupid. It's not 60% dominant. It's like 96% or 95% dominant, right? The thing, if you compare it as a crypto asset to a like kind of proof of work crypto network, right? That's meant to be a store of value. You know, you're lucky if you can scrape together 5% of other stuff in the last bucket. So there is no real competitor. Catapulting the early crypto industry into a global digital asset economy, stable coins, crypto kitties, and all sorts of NFTs. What did they have? The industry had a lot of wonderful, interesting, exciting ideas. Companies, celebrities, politicians, lobbyists, lawyers, institutions, adults, capital markets, capitalists, capital, governments, municipalities, they are all being integrated into this crypto economy.
The cognitive dissonance this creates for long-term Bitcoin holders who aligned with the earlier positioning is completely normal. Trust is important in Bitcoin, and every previous high-yield retail products built on Bitcoin custody or leverage collapsed, and Bitcoin survived each one. That's important. Celsius, BlockFi, Voyager, and Luna all offered retail investors yield on Bitcoin adjacent products. And they all failed in ways that damaged Bitcoin's reputation and adoption because the public attributed the failure to Bitcoin and overlooked the structure built on top of it. The cash flow mechanics of Strategy's preferred structure, where new capital funds existing obligations, are structurally similar to those predecessors. Of course, the similarity is narrower. But even if every question resolves in Strategy's favor, a public failure of this structure would be read as a failure of Bitcoin. Just like it did with FTX, pushing regular people away from adopting the protocol for even longer. Mechanically, the products exist and function as described in Strategy's filings. The cash flows are real as long as the three conditions hold. Conceptually, what those products do to the theory of sound money, whether they extend it or contradict it, depends on how each of us understand what Bitcoin is for. If we zoom out from a single company to the broader landscape, the same mechanism operates across the entire ecosystem. This section examines why the companies building on Bitcoin keep drifting away from it, and why the ones that remain Bitcoin only are almost always the ones that never took fiat capital at scale. Independent research across 169 companies operating in the Bitcoin space reveals a structural pattern that's difficult to dismiss once you see it. 56% are not actually Bitcoin only. Among private companies with raises above 50 million, all 16 in the dataset have drifted. Every single one. The non-Bitcoin products cluster around a predictable set of categories. Stablecoins, Bitcoin collateralized lending, layer 2 smart contract platforms, ordinals, asset tokenization, and yield products. Above 5 million in funding, drift is the majority outcome at every bracket, with the rate climbing as the raise grows. Venture capital funds operate on a simple premise: invest early and return multiples within 7 to 10 years. The fund's own investors, the limited partners, expect returns that justify the risk and the illiquidity. A fund that does not deliver those returns has less chances of raising more funds in future rounds. This naturally creates an internal pressure on the portfolio companies that has nothing to do with Bitcoin's values and everything to do with the financial structure sitting above it. A company building a Bitcoin wallet, a node implementation, or privacy tool is building critical infrastructure for the network. Whether products like these can deliver venture scale returns inside a fund's window is a question that this dataset cannot answer. What it can show is a snapshot of what funded companies actually did under that pressure. And it's the same thing over and over. They bolted on lending against Bitcoin collateral, stablecoin integration, tokenization features, yield products, and more. Each addition moves the products further and further away from Bitcoin and closer to the fiat financial system the company's founders probably set out to replace. The capital demands it. Now, a company can add USDT or USDC support and still claim to be building on Bitcoin, particularly if the stablecoin runs on a Bitcoin sidechain or via Taproot assets. But a stablecoin is a centrally issued token, and the issuer can freeze any balance and blacklist any address. That is the control architecture of a CBDC, just operated privately. And it's being installed on Bitcoin's rails. Yes, stablecoins can help onboard people who wouldn't have used Bitcoin otherwise, but the architecture remains what it is. The product looks Bitcoin native, the economics are not. Maybe the founders who took large raises were not necessarily betraying their principles. Many of them likely believed they could take the money and stay the course. The problem is that VC math doesn't always care about principles. It cares about returns, and the returns at that scale require products that the Bitcoin protocol alone does not generate. The capital came with expectations, and those expectations can bend the product. However, the companies planning fiat products on top of Bitcoin are probably the ones that can credibly raise 9 figures in the first place. Venture scale capital and Bitcoin-only products do not coexist in this dataset. That's just the way things are right now in 2026. And so, of course, VC math isn't the only pressure. Mining companies expanding into AI and GPU hosting are doing it because halving cycles and fiat-denominated energy costs squeeze their margins to the point where diversification became a survival strategy. Sometimes it's the fiat system's cost structure making the Bitcoin-only path economically unsustainable. Among the 64 companies in the dataset that received equity investment from funds that explicitly identify as Bitcoin-focused, 45% have introduced non-Bitcoin products. Oftentimes, the Bitcoin-denominated fund's benchmark is Bitcoin's CAGR, so every portfolio company must outperform simply holding the asset. That pressure naturally produces fiat incentive structures inside the companies it funds, regardless of the fund's or founder's intentions. The remaining companies that have not drifted are hardware wallets, community apps, tiny open-source projects, and a handful of exchanges that have held the line. Almost all are bootstrapped or operating on small raises from funds that understand what they are investing in. Small teams, minimal external funding, revenue from Bitcoin-only products, and often open source. These are the companies building the infrastructure that Bitcoin actually needs. And structurally, they're the least visible. The contrast is stark. In this data set, one company was founded with less than 2 Bitcoin and has never taken a single dollar from an investor. It builds a Bitcoin-only product, operates profitably, and most people in the space have never heard of it, myself included. Another company raised hundreds of millions of dollars, carries a multi-billion-dollar valuation, and sponsors major conferences. Its product line now includes asset tokenization and smart contract functionality. One of these companies is building what Bitcoiners actually need. The other has different incentives. And the visible one is not the pure play. Smaller Bitcoin-only companies do not have a marketing budget funded by a Series A. They do not sponsor conferences. They do not appear in the Bitcoin publications that depend on advertising revenue from the companies that did take the money. While the well-funded companies enter the virtuous loop, the bootstrapped ones remain less visible. The pattern across this entire series is the same. The people and companies building what Bitcoin actually needs, they have the smallest megaphones. Because in 2026, reach and distribution still scale with fiat funding. The counter-argument, of course, is that this drift is necessary. These products are how millions of people interact with Bitcoin for the first time, and a company building in this transition cannot pretend the transition is already over. There's truth in that, but no company in this dataset has added fiat products and later removed them to return to Bitcoin only. Both things are true at the same time. The companies adding fiat products and stablecoins are responding to real demand from real users who still pay rent in euros and dollars. And the structural consequence of responding to that demand is that the company stops building for Bitcoin and starts building for the fiat system's continuation on Bitcoin rails. The fact that the drift is understandable does not make it less real. And it means that the fiat system does not need bad actors to capture Bitcoin's infrastructure. It just needs justified cognitive dissonance to make the transition take long enough that the economic survival forces the drift on its own. This is why the real problem was never really on-ramps. Most of them already exist. The problem is what gets funded. The problem is where the megaphone goes. The problem is how fiat funding is capturing different aspects of Bitcoin, including development. Every section of this series describes the same mechanism. Fiat funds the infrastructure, and fiat incentives follow. The protocol has no treasury, no foundation, no built-in compensation mechanism. But open source developers need funding. Developers either fund themselves, receive grants from nonprofits and corporations, or eventually stop contributing. In the absence of a Bitcoin native funding model, Fiat structured organizations filled the gap, inevitably bringing Fiat incentive structures with them. This section references findings from Hodlonaut's investigation, The Capture, which documents the consolidation of influence over Bitcoin Core development through public records. I recommend you read it, and everything I mentioned in this video can be checked in the sources in the links in the description. The investigation documents how the selection operated through social proximity and alignment rather than technical merit alone, how dissent was structurally punished, and how the governance mechanisms that were supposed to protect the project were repurposed to insulate the funding network from challenge. It's the same selection pressure that operates in every fiat institution on Earth. Proximity to power and paper money determine advancement, while independence eventually determines irrelevance. There's a narrative in the Bitcoin community that maintainer burnout is normal, that this is the nature of open source work. Maintainers exhaust themselves, step down, and then others take their place. The community has absorbed this as an unfortunate but inevitable feature of the landscape. The contribution histories, the funding decisions, and contributors' own public statements document this in Hodlonaut's investigation. But what if it wasn't just burnout that was actually happening? There's also a first-hand account on record. In a March 2026 presentation on Bitcoin Core governance, John Attack, a core developer since 2019, described maintainers who stay until they burn out, with no plan for passing the torch, and then describe the dynastic effects that follow, a pipeline in which your whole life changes when you get your first serious funding. He describes his own year-long wait for funding, while friends waited 3 or 4 years, and contributors were systematically pushed away from the project after questioning maintainer nominations. I cannot say with certainty what happened inside these dynamics, but if independent contributors lasted at the same rate as funded ones, the thesis would be wrong. If they do not, then what the community calls burnout is the predictable outcome of a funding structure that rewards compliance and makes independence unsustainable. The people who care the most about keeping Bitcoin Bitcoin and fighting against the fiat incentives are the ones who are most likely to burn themselves out. And calling it burnout converts a collective failure into a personal one. It's easier to point fingers. But when independent contributors step back and disappear, the seats do not stay empty. They fill with people the funding structure selected precisely because they will not push back. Then the culture shifts. Bitcoin shifts. And what changed is the incentives it serves. What makes Bitcoin Core's capture particularly significant is that it happened to the layer of Bitcoin's infrastructure where the protocol's rules are literally written. If the reference implementation drifts from what Bitcoin was created for, cypherpunk principles, if it is eventually no longer decentralized or secure, the protocol itself is at risk. This is what precisely happened when Bitcoin Core version 30 increased the default op return data limit from 83 bytes to 100,000 bytes against community pushback. To be precise, this was a relay policy default, never a consensus rule, and core contributors argued that the old limit was already trivially bypassable through inscriptions and other encodings. Yes, there's a technical debate, but that's exactly the point. And either way, the decision was made. It was imposed. But the community's immune reaction kicked in pretty quickly. Over 22% of all reachable nodes have migrated over to Bitcoin Knots, another implementation that allows operators to control their own mempool settings. And many others never upgraded to Bitcoin version 29 or version 30. As of June 2026, almost 14% of the network are also signaling for BIP110, a proposed temporary soft fork by pseudo-anonymous developer Datham Ohm that would restrict non-monetary data at the protocol level, requiring 55% miner signaling to activate. Node counts can be inflated, so the precise numbers deserve skepticism. But even heavily discounted, the direction is unambiguous. Individual node operators switched implementations specifically to reject the changes made by Core. For some reason, a lot of talk about BIP110 is being censored, and I'm speaking from personal experience. This in a world where most Bitcoin educators and influencers have stayed silent on the matter, naturally due to their own fiat incentive dependencies, which I will talk about now. The attention economy rewards engagement. How do you get it? Clickbait, price predictions, fear-mongering, these generate clicks. Finance YouTube channels typically earn $10 to $25 per 1,000 views from ads alone, with top performers reaching $29 or more per 1,000 views. So a single video with 300,000 views can generate $7,500 or more before sponsorships, affiliates, and all the other ways to monetize a video. That's just from YouTube ads. And it compounds. Every video continues earning as long as it keeps generating clicks. Clickbait is just profitable. Technically grounded Bitcoin education? Not so much. This is not a complaint, by the way. This is just a description of how the incentive structure works. At one point, I made some videos about Bitcoin price on a small unmonetized channel. But once I really understood Bitcoin, I deleted them. I realized I was just contributing to the fiat system. Across the Bitcoin education space, it's now common for services to be recommended by multiple well-known people at once, each recommendation sounding like a personal endorsement. Often these are actually affiliate deals which pay out per sale. It might not seem like a big deal unless you know that some of these sales can lead to $450 per conversion. And so the incentive is very strong to try to get the viewer to buy. When I looked at how these promotions were disclosed across 15 channels, the pattern was consistent. The bigger the payout, the less obvious the relationship was. The incentive is clear. An influencer earning hundreds of dollars per conversion has every reason to make it sound like a personal endorsement rather than a paid placement. What this means for you as the viewer, a recommendation that sounds like personal conviction may be a paid ad placement. And without disclosure, you have no way to tell the two apart. But ads and affiliate deals are far from the only monetizable channel. Influencers also earn from sponsorships. Publicly filed press releases from a single Bitcoin company showed individual creator sponsorships worth tens of thousands of dollars per month in cash and company shares, with one relationship exceeding $480,000 over 18 months. What's less obvious is the impact these incentives produce. Even if a creator wanted to scrutinize their sponsors' practices, their income depends on not doing so. A creator sponsored by a lending platform is structurally incentivized to overlook the risks of Bitcoin collateralized debt without jeopardizing their livelihood. The structure traps good people into silence as the rational choice. In 2026, there is no shortage of issues in Bitcoin that warrant serious public scrutiny. And yet the creators with the largest audiences are often the quietest on exactly those issues, or actively amplifying the narratives their sponsors need spread. This dynamic compounds into a self-reinforcing system. Clickbait grows the audience attracts sponsors, the sponsors fund more content and more visibility. Every turn of the loop widens the gap, and every turn of it is funded by fiat incentives. But that loop has one thing that it cannot generate: your attention. That's the only thing that decides what feeds this machine. In late 2025, I proposed a presentation to a Bitcoin conference that has a great reputation in the space and is considered high signal. I told them upfront that my business model is value for value only and that I don't do any affiliate deals. In order to get a group discount for my local community, I needed to get an affiliate code, but it was just for them if I got accepted to present. Yet all subsequent communication was about if I had promoted the event and sold tickets. Whether I was invited to attend was never actually confirmed. Even in Bitcoin, contribution is still sometimes measured in fiat terms. And if it doesn't convert to sales, it doesn't register. While I was not accepted at the conference I actually wanted to present at and would have done for free, I was offered a fully paid trip to a different major conference. 100,000 euros, flights included, almost 1.5 Bitcoin at today's price. But the offer screamed fiat incentives, and I said no. But my point with conferences is that it concentrates visibility, it concentrates distribution, and it favors the fiat incentives. The same logic operates even on platforms that were supposed to be different. On certain Nostr clients, new users are placed into pre-selected follow lists or are obliged to choose from lists during onboarding. The accounts on those lists are not necessarily there because they're the highest signal. Generally, it's because they're known to the client developers or group creators. The effect on audience metrics is the same as on many fiat platforms. Larger accounts compound by default of being in pre-curated lists, while smaller pleb accounts are required to grow organically. Many smaller accounts describe Nostr like yelling into the void because, structurally speaking, on certain clients, they are. And it's not speculation. I published a full structural analysis of this pattern, including relay data, engagement comparisons, and ZAP distribution. I actually queried all the relays to collect this data. The data shows the same Cantillon logic that the STRC analysis identified in capital concentration earlier, but operating this time on attention. New user attention flows first and disproportionately to a small number of pre-selected accounts that continue to grow, while everyone else publishes into silence. And the onboarding retention numbers are clearly telling. I mean, less than 1% of new users on the Nostr protocol are still there 3 weeks later. 1%. I work at this full time. I have no ads, no sponsors, no affiliate income. And I have no fiat assets to fall back on. My YouTube channel is demonetized and I'm all in on Bitcoin. In 2026 so far, my total income from Zaps and book sales, which I also consider value for value, is 800 euros. Both of these things are true. I'm incredibly grateful for that. And it doesn't pay the bills. I just think it's so important to know the dynamics between what creators are experiencing on the platform depending on the choices that they make. But you might say to me, Daniela, what's wrong with taking sponsors, running YouTube ads, trying to get in front of as many eyeballs as possible? You can't expect everyone to work value for value only. That's kind of crazy. And I would agree with you 100%. Everyone should do what's right for them. My point is that value for value cannot scale. It cannot scale as an alternative to the fiat creator economy if the audience is still funding the fiat side. The model is not broken. Value for value is great. But the flow of attention is still pointed in the direction of fiat money. It's the opposite direction of what most Bitcoiners say that they want to build. What's right for me is producing content that doesn't waste your time. I don't want to monetize your personal data, be swayed by fiat incentives from sponsors, or have some random ad cut off a deep conversation. That's my choice, and I'm not asking everyone to make it. What I want to point out here is the gap between what we say we want in Bitcoin, cypherpunk values, freedom, sovereignty, new business models that cut out third parties, and then what's actually being funded. And I'm also aware that this gap is a completely normal part of a transition, this paradigm shift. And it also took me a long time. I mean, I used to watch a lot of fear mongering because I needed to know what was going on in the world. We all have our cognitive dissonance and our justifications. And then when it comes to the incentives, I mean, fiat is just going to fiat in Bitcoin, of course, to be expected. In the meantime, everyone is transitioning from one economic reality to another. And some of our habits just haven't caught up with our new beliefs. That gap is understandable, but it has consequences. If creators who stayed value for value only run out of runway while creators promoting fiat on Bitcoin keep growing, that is the incentive structure working exactly as it's designed. That is fiat promoting itself on top of Bitcoin. The question is whether we're comfortable with the results of that. There's a scene in The Matrix where a child bends a spoon with his mind. He tells Neo, "Do not try to bend the spoon. That's impossible. Instead, only try to realize the truth. There is no spoon." In the film, this works because the Matrix is a simulation and the spoon is code. Once Neo sees through the illusion, the rules stop applying. Bitcoiners love this analogy because it captures something so true about fiat money. The system only works as long as people believe in it. The moment enough people see through it, the structure loses its hold. In that sense, there is no spoon. Fiat money has no fixed supply, no anchor in reality, no mathematical enforcement. It's all an illusion, a decreed distortion of natural law. Bitcoin removes the mechanism that made every previous iteration of that pattern possible. But here's where our reality parts ways with the film. Neo could simply stop believing in the spoon and it would bend. We cannot do that because despite knowing the spoon is not real, it's still here solid in our hands. It manifests like fiat obligations, like rent and taxes, and fiat-based structures that govern how most of the world still operates. Someone standing in 2140 will look back at this time and see clearly who was building the bridge from the old system to the new one, and who was standing on the old side calling themselves a Bitcoiner. From the future, the distinction will be obvious. From inside the overlap where we are right now, it's the hardest thing in the world to see. Part of why this is so hard to see is identity. We built our sense of who we are inside the fiat system, and knowing the rules are broken does not automatically free us from the self we constructed under them. The overlap may feel like thinking clearly, like being practical, like the reasonable middle ground between conviction and reality. Keeping the fiat job we hate is a good example of this, the wise thing to do. That's what makes living in both worlds a perceptual trap, where rationalization feels indistinguishable from reason. The other half is material. Rent is denominated in fiat for most of us. We're building the bridge as we cross it. Some of us are crossing from fiat-based stability, like careers and capital built in the old world. Others are crossing with nothing but conviction. Both are creating the path forward, but the weight is not distributed equally, and pretending otherwise does not help anyone cross. There's a difference between knowing something is true and living as though it is. Most of us are somewhere in the distance between those two things without fully realizing it. We keep doom scrolling because we need to know what's happening in the world. Something I did. We bought Bitcoin and then we went back to the fiat mine on Monday. We chose to forfeit self-custody because wrench attacks are up. Or multi-sig is too complicated and risky. None of that felt like a contradiction because the intellectual knowing just felt like enough. Now, I'm going to give an example of cognitive dissonance outside of Bitcoin because I feel like this demonstrates the cognitive dissonance even more. It's easier to see maybe in another industry. And it's present everywhere where fiat lives. In 2025, over 50 comedians performed at a Saudi government-funded festival after signing contracts that explicitly prohibited criticism of the regime paying them. The rationalizations were similar to the ones this series has documented in every department. One comedian said he was advancing free speech. Another affirmed she was helping LGBTQ people feel seen. From inside the overlap, every one of those felt like thinking clearly. The same way keeping a fiat job we hate feels like the right thing to do. The comedians who built careers on free speech signed away their rights to exercise it. The same way creators who built their audience on Bitcoin conviction avoid criticizing the sponsors paying for their reach. Saudi money entered American comedy, and American comedy started serving Saudi interests. Fiat money entered Bitcoin, and Bitcoin's human infrastructure started serving fiat's interests. Look at any industry, including the one that you might actually work in. The mechanism is always the same, but unlike anything else outside of the field, Bitcoiners are supposed to be the ones who understand the problem, fiat money, and are ushering in the shift away from fiat. A few of us are trying to cross, but realize the support structures that would make Bitcoin-only value survivable have not yet been built, because most of the community's energy is still pointed in the other direction. So the many who hesitate to cross, including maybe yourself, are right. I understand. They sense correctly that fully crossing is not yet sustainable. And that instinct is exactly why so few have tried. But that hesitation measures the state of the bridge as it is. Every courageous early crossing lays the plank for the next person to walk on. And that gap between knowing and living closes. One person and one decision at a time. Honestly, this past year has surfaced a quiet disillusionment in many, including myself. Some of the most committed Bitcoiners I know have quietly stepped back from the space this year, not because their conviction changed, but because the distance between what the community says it actually supports and what it actually does has become too heavy to carry for now. When those people disappear, we reach for that word again, burnout. But here's the thing, coming from the personal development and spirituality world, I can only see another parallel. The spiritual world has run the same move on money for decades. It's one of the reasons why I wrote my book. When money manifestation fails, the teachings blame the practitioner's vibration instead of examining the container that they're manifesting from, fiat money. Naming the structure allows us to properly orient our personal responsibility. It allows us to actually see what's operating beneath everything. The transition from a fiat standard to a Bitcoin standard happens at the human level. It's in the daily choices that we make while the spoon is still solid in our hands. The deeper issue is that the fiat system lives inside of us. We inherited fiat assumptions about what's practical, what's reasonable, and those assumptions didn't disappear when we bought Bitcoin. They show up in how we orient our attention, how we spend our money, and which discomforts we've quietly decided are someone else's problem. The disillusionment that some of us may feel is valid. But the rage, the division, the polarization, and the finger pointing, that's exactly what the fiat system needs to keep us distracted while it consolidates. And so I want to be clear, I'm not blaming anyone in this series. I want to point out a systemic structural pattern, and I want to invite you to choose what's best for you. The fiat system does not need to co-opt Bitcoin. It can't be co-opted anyway. It only needs to co-opt us. For the first time in 5,000 years, our reaction can actually change the outcome. The prison door is open. I choose to run knots and BIP 110. I choose to take self-custody, to have my savings in a multi-sig setup that's dispersed internationally. As a public Bitcoiner, I choose to build. The spoon was never real. We know it. What we do with that wisdom is the only thing left that matters. Thank you for being here.